Two men walk into an insurance office on the same Tuesday afternoon. Same age, 42. Same goal, $1 million, 20-year term policy. They're about the same height, about the same weight, neither one smokes, both have steady jobs, both have families counting on them. And then the offers come back. One guy gets quoted $58 a month. The other gets quoted $142. Same coverage. Same timeline. Same Tuesday. Over 20 years, that second person pays more than $20,000 extra for the exact same death benefit. So what changed? What's the difference hiding inside those two almost identical applications? Today, we're answering that question. And the answer lives inside a process most people never see, never really understand, and definitely don't feel like they get to influence. It's called underwriting. And if we're being honest, underwriting is the most powerful invisible force in life insurance pricing. Welcome to Wiseside Life and Legacy. I'm your host, Nakel Nikiema. This is episode 4, and we're calling it, How Insurers Decide. We're going behind the curtain with someone who's been doing this work for 2 decades. A real underwriter, not a sales pitch, not a commercial, not a rumor off the internet. We're going to talk about what underwriters look at, what they don't care about, what actually triggers concern, and what you can do in the 90 days before you apply to give yourself the best shot at the best rate. This one can save you real money. Not hypothetical money. Thousands of dollars over the life of a policy. So settle in. If you're just joining us, this is episode 4 of a 24-episode series built to break down life insurance in plain language. Episodes 1 through 3 were the why, the vocabulary, and the math. Today is about the gatekeeper. In the studio with me is Marcy Reeves. Marcy has been a life insurance underwriter for 20 years. She's seen the industry change through multiple economic swings, the rise of accelerated underwriting, the pandemic, and this new era where data is everywhere. She also holds the FALU credential, Fellow of the Academy of Life Underwriting, which is one of those designations you don't get by accident. And Marcy has reviewed tens of thousands of applications over her career. She told me something when we first talked that stuck with me. She said, most people overpay because nobody explains how the game is actually played.
I did say that. And just to be clear, I'm not here to bash the industry. Underwriters are mostly careful, serious professionals. But I am here to make the process understandable, because when people understand it, they tend to get better outcomes. Better pricing, fewer surprises, more trust. Everybody wins.
I like that. Alright, for the listeners who have never heard a clear definition, give me the quick version. What does an underwriter actually do?
An underwriter is the person at the insurance company who decides whether your application gets approved, what risk class you fall into, what you'll pay, and if there are any special terms. We're basically the decision point between you and the coverage. We take a bundle of information, your application answers, medical exam results if there is an exam, prescription history, motor vehicle reports, sometimes a credit-based insurance score, and an industry database called MIB. We put it all together and make a call. Approve, decline, approve at a higher rate, sometimes approve with exclusions depending on the situation.
And that call can shape what someone pays for decades.
Exactly. And honestly, this is what I tell friends. The most expensive part of life insurance isn't the policy you buy. It's the policy you could have qualified for if you'd prepared.
That's the episode right there. Okay, let's get into the mechanics. If an application is complete and it lands in your queue, what do you look at first? And in what order?
First thing, it's not paper on a desk anymore, it's a digital file. But the flow is similar. I'm usually reviewing 6 big categories. Category 1 is basic demographics, age, sex, height, weight, your state of residence. Those set an initial baseline. Category 2 is the application answers. That's your personal and family medical history, lifestyle, occupation, hobbies, and financial questions. And that financial part matters, because we also have to confirm the coverage amount is reasonable for your income and assets. Category 3 is medical evidence. For many people, that means the permed exam with blood and urine, sometimes extra tests for larger face amounts. Category 4 is third-party records, doctor records if we request them, prescription databases, motor vehicle reports, and that MIB database, which flags things from other insurance applications. Category 5 is financial verification, mostly for larger policies, tax returns, business documents, statements, depending on the case. And Category 6 is becoming bigger every year. Predictive modeling, electronic health records, and other forms of data analytics, and it's moving fast.
That's a lot. Most people think life insurance underwriting is, they take my blood pressure and that's it.
Yeah, the exam is important, but it's not the whole story. People are shocked when they realize the lab work might be, say, 40% of the overall decision, and the rest is a documentation trail.
Okay, so let's talk about a scenario that happens all the time. Someone answers a question one way on the application, but the prescription history tells another story. Like they say, no high blood pressure, but there's a blood pressure medication in the pharmacy record.
That's one of the first things underwriters are trained to notice, mismatches. And here's the thing, people assume it's fraud. Sometimes it is, but more often it's forgetting, or not realizing a one-time prescription counts or thinking, well, my doctor said it was borderline, so I don't really have high blood pressure. When we see that mismatch, we don't automatically decline you. But it does trigger follow-up. We might ask more questions, request your doctor records, or order an attending physician statement. And that extra scrutiny can slow the process down, and in some cases, it can push you into a worse rate class. The worst answer on an application isn't just a wrong answer. It's an incomplete answer that collides with data we already have.
So the real-world takeaway is, don't play games, and don't minimize stuff that seems minor.
Exactly. Small things feel small to you, but they don't look small when they show up as a surprise in the report. If you disclose something up front and explain it clearly, it typically underwrites cleaner than when we discover it ourselves.
Now I want to connect this to the bigger picture. People hear underwriting, and they imagine someone kind of guessing. But you're not guessing. There's an actuarial system behind you.
Right. Underwriting sits on top of a huge actuarial foundation. Actuaries have studied millions of policy outcomes. They can estimate, with very refined probability, how different risk profiles behave over a 20-year period. My job isn't to invent the pricing. The pricing already exists for categories. My job is categorization.
So you're sorting people into buckets.
That's the simplest explanation. The company has buckets, called rate classes. The underwriter decides which bucket fits.
And the spread between those buckets is where that 58 versus 142 thing happens.
Yep, that spread is the whole story.
Alright, let's break down the bucket system, because this is where people's jaws usually drop. Walk us through the core rate classes the average person might see.
Most carriers have a similar structure with different names. At the top you have Preferred Plus. Some companies call it Super Preferred, Preferred Best, stuff like that. That top class usually requires near-perfect health metrics, clean family history for early heart disease or cancer, excellent blood pressure and cholesterol, healthy build, clean driving, no risky hobbies, no nicotine use, and a very clean prescription history. Only a small portion of applicants land there, maybe 5 to 10%. Next is Preferred. Still excellent. Maybe you've got slightly higher cholesterol, or one small factor that keeps you from the top tier. Still a strong class. Perhaps 15 to 20% of applicants get Preferred, depending on the pool. Then you get into Standard and variations like Standard Plus. This is the big middle. This is where a lot of normal, generally healthy adults land, including people with well-controlled blood pressure on medication, slightly elevated BMI, or family history that creates a little extra risk. Below that is Substandard, which is usually expressed as table ratings, Table A and B and C, and so on. Each table adds a surcharge. Often it's increments like 25% more than the base standard rate per table. And separate from those tiers is the smoker versus non-smoker classification. If you've used nicotine in the carrier's look-back period, you can be put into smoker rates, and those can easily be 2 to 3 times higher than non-smoker.
2 to 3 times higher for nicotine. That's huge.
It's the most expensive lifestyle factor in life underwriting, and it includes cigarettes, cigars, chewing tobacco, vaping, nicotine replacement, patches, any nicotine exposure. Some carriers treat occasional cigar use differently, but you can't assume that. You have to ask.
Let's put some rough numbers on this so people can feel it. Say a 35-year-old guy applies for a $500,000, 20-year term policy. What does that look like across classes?
Ballpark numbers, not exact quotes, but typical in today's market. Preferred Plus could be around $26 a month. Preferred maybe around $32. Standard Plus could land around $40. Standard might be in the upper $40s. A Table B rating could push you up into the $70s. A smoker rate at standard could be close to $100 a month, give or take, and smoker plus substandard can go well beyond that. So from top class to a smoker substandard scenario, same age, same face amount, you can be looking at something like a 5 times premium difference.
And that's how two people who look basically the same end up on completely different monthly payments.
Exactly.
Now here's something that really changes the way people think about this. You said earlier that underwriting often isn't about rewarding good habits as much as it's about avoiding red flags. Explain that.
Mentally, underwriting is often a process of starting at the top and looking for disqualifiers. We don't usually start at standard and ask, "Can I promote you?" We start at preferred plus and ask, "What knocks you out?" One significant factor can drop you. Common disqualifiers are higher BMI than the carrier's threshold, higher blood pressure at the exam, cholesterol beyond guidelines, any nicotine in the look-back, certain family history events before 60, a recent DUI, risky hobbies, certain prescriptions. Each carrier has specifics, but those are the usual suspects.
So for listeners, the question becomes, what flags might I be carrying without realizing it?
That's the right question.
Alright, let's move into what people think is the whole ballgame, the medical exam. What happens in a typical permed exam?
It's usually a nurse or phlebotomist coming to your home or office. It takes about 30 to 45 minutes. They'll measure height and weight, take blood pressure, pulse, confirm health history questions, draw blood, and collect urine. If the coverage amount is high enough, maybe over $1 million or $2 depending on company, they may add an EKG.
And the labs, what are they actually checking? People always ask me that.
Standard panels are pretty broad. They're looking at cholesterol breakdowns like HDL and LDL and triglycerides. They'll check glucose, often A1C. They'll look at liver enzymes, kidney function, protein markers. Urine testing includes a number of health markers and, often, drug screening. And importantly, they test for tobacco metabolites like cotinine.
So if you tell the agent you don't smoke, but there's cotinine in your system,
then you're classified as a smoker at most carriers. It's not personal, it's just how the guidelines work. It also catches the "I stopped last week" approach. And I get it, quitting is hard. But most companies look for sustained nicotine-free history for the better non-smoker pricing. The timeline varies, but you're usually talking many months to multiple years for top classes.
Let's talk about the evidence trail beyond the exam, because this is where people really don't know what's being pulled. Prescription history. How powerful is it?
It's one of the biggest tools underwriting has now. With your consent on the application, we can pull pharmacy history going back years. You'd be shocked how many people don't realize that. We'll see medications, dosages, how long you've been on them, which doctors prescribe them. And yes, you can often infer the underlying condition from the medication, even if someone didn't disclose it.
So it's not just, did you take a pill, it's basically a health timeline.
That's a good way to put it.
Now the other acronym you mentioned earlier, MIB. People hear that and it sounds like some secret agency.
It does sound dramatic. MIB is a member organization used by many life and health insurers. When you apply for certain types of coverage, the insurer may submit coded information about medical or lifestyle factors from your application. Later, if you apply again, a company can check MIB to see if there are codes from prior applications. It's not a full medical record. It's more like flags. But those flags are enough to prompt questions if something doesn't match what you're claiming now. And consumers can request their own MIB file once a year for free. If someone was declined and they never got clarity, that can be a useful move.
That's one of those tips people don't hear anywhere. Motor vehicle reports. What are you looking for there?
Mostly DUIs and patterns of serious moving violations. A DUI in the recent past can take someone from top tiers down to standard or worse, depending on timing and severity. And repeated reckless driving issues do matter because they correlate with mortality. Life insurance isn't just medical risk, it's mortality risk, period.
Which is the perfect setup for the lifestyle factors. What are the surprise disqualifiers, the things that people don't think count, but absolutely count?
There are a handful that come up again and again. International travel is one. If someone frequently goes to areas with active conflict or high risk, underwriting may adjust the offer, add limitations, sometimes even exclude death in specific locations depending on carrier rules. Hazardous hobbies are another big one. Private aviation, especially as a pilot, deep scuba, high-altitude climbing, frequent skydiving, racing, things like that. Often the company adds a flat extra, meaning it's not a percentage rate class change. It's a fixed extra cost per year per thousand or per million of coverage. It can add up. Occupation can also matter. Most office jobs are straightforward, but certain jobs, like some law enforcement roles, oil field work, commercial fishing, active duty military and deployment zones, professional contact sports, those can carry added underwriting considerations. Family history is another one that frustrates people. If a parent or sibling died from heart disease or cancer before 60, that can affect your class even if you're currently healthy.
Because the underwriting view is, this increases probability.
Correct. Underwriting is statistical.
Let's talk about one topic carefully, because I know listeners have feelings here: mental health. How does mental health history show up in underwriting?
It depends on severity and stability. The industry has improved a lot over the last decade. Many carriers will offer decent classes for well-managed depression or anxiety, especially with a stable treatment history. More severe cases, recent hospitalizations, suicide attempts, untreated major conditions, those can still lead to tougher outcomes. But I want to say something clearly. Being treated usually looks better than being untreated. Stability matters. Follow-through matters. Getting care doesn't hurt you the way people fear it does.
That's important. Because some people avoid help thinking they're protecting their future insurability.
And that's a bad trade, from an underwriting standpoint and from a life standpoint.
Alcohol use. Where's the line there?
We pay attention to it. Moderate use typically isn't an issue. Patterns that suggest heavy daily use trigger questions. Any history of treatment gets reviewed closely, and outcomes depend on how long ago it was and what the recent history looks like.
And marijuana, now that legality varies all over the map.
Carriers have shifted. Many now treat occasional recreational marijuana differently than tobacco. Someone who uses occasionally may still qualify for non-smoker rates at some companies, but heavy daily use might be treated more harshly at others. This is where shopping matters, because underwriting philosophy varies a lot by carrier.
You mentioned something earlier that's controversial: credit-based insurance scores.
Not all carriers use it for life, and it's regulated, but some do. The argument is it correlates with certain behaviors. It's not universal, but if someone has very poor credit, it's worth asking the agent whether it plays a role with that specific company.
All right. Now we get to the practical part, because listeners love specifics. Let's say someone is planning to apply in the next 90 days. What can they do right now to put themselves in the best position?
90 days can absolutely move the needle. Longer is better, but 90 days is enough to improve key markers. Here's the playbook, and I'll say it up front: the best rate is usually earned before you ever fill out the application. Step 1. Schedule a routine physical with your doctor about 6 to 8 weeks before you plan to apply. Get your baseline: blood pressure, cholesterol, blood sugar, weight, BMI. You need to know your numbers before the insurance company tells you your numbers. Step 2. If blood pressure is borderline, work on it hard for 8 to 12 weeks. Less sodium, consistent activity, better sleep, and yes, even a modest weight change can impact it. Step 3. Cholesterol. Diet changes, exercise, and if medication is appropriate, Start it early enough that your labs stabilize. Underwriters like stability, not a one-time miracle reading. Step 4, BMI. Every carrier has built charts. Sometimes 5 or 10 pounds makes the difference between one class and another. And when you see what a class change does over 20 years, those few pounds can be worth a lot financially. Step 5, all nicotine stops. Completely. Now. Not next month. The clock starts when you stop, and nicotine testing can catch recent use. Step 6, driving record. No new tickets. If there's a DUI, it may be smart to time the application so you're farther away from the incident. Often 5 years is a common point where things start to look better. Step 7, prep for the exam itself. Hydrate the day before. Avoid alcohol for at least 72 hours before. Don't crush a huge, heavy meal the night before. And avoid intense workouts within a day of the exam because some markers, like certain liver enzymes, can be temporarily affected. Step 8. Schedule the exam in the morning if you can. People tend to be more rested, and blood pressure often reads lower earlier in the day. It's not magic, but in borderline cases, small differences matter. Step 9. Gather records. If you've been treated for something, have your recent labs and doctor notes ready. Proactive disclosure and faster documentation can prevent the file from stalling and can reduce the need for repeated requests. Step 10. Work with an independent broker when possible. Captive agents have one carrier. Independent brokers can shop multiple carriers, and carriers treat the same profile differently. Matching matters.
That's a real plan. Not be healthy. It's like a checklist.
Because vague advice doesn't save money. Specific actions save money. I've seen people move from standard to preferred plus in about 12 weeks because they address the right things. And that can easily be a 30 to 40% premium difference.
Over 20 years on $1 million policy, we're talking 15 to 20 grand kind of savings.
That's realistic, yes. And that's why the education gap is so expensive.
I want to hit a listener question before we wrap, because it's a question I hear constantly, and I know you do too. A listener wrote in, I'm 46. I was diagnosed with type 2 diabetes 3 years ago. I take metformin. My A1C is around 6.8. I'm not overweight. No other health issues. Am I basically uninsurable?
No, not at all. And I want people to hear that clearly. Absolutely not. Type 2 diabetes is common in underwriting. Many companies insure it every day. The person likely won't qualify for the very top class, but standard or standard plus can be achievable for well-managed cases. For that specific listener, things that help are A1C around 6.8 suggests decent control. 3 years since diagnosis gives a track record. Metformin is a normal first-line medication, so it shows engagement with care. And no complications is huge, meaning no eye damage, kidney issues, neuropathy, those kinds of things. If I saw that file, assuming everything else is clean, I'd expect a decision somewhere around standard, possibly standard plus depending on carrier and full profile.
And zooming out, what's the principle for people who have a condition and they're scared to even apply?
Uninsurable is a much smaller category than people think. Most chronic conditions, if they're managed and stable, are insurable. What tends to make cases truly difficult is a very recent serious diagnosis where prognosis is uncertain, multiple serious conditions at once, or a very recent major event like a heart attack or certain cancers within the last year. Outside of that, most people can get coverage somewhere. The real question becomes at what rate and with which company. And even when traditional underwriting isn't a fit, there are other products out there, like simplified issue, guaranteed issue, and other options. They're not always the first choice, but they can provide protection.
And your advice is, don't let fear make the decision. Actually apply. Get a real answer.
Yes, people torture themselves with worst-case stories. Get the quote. Get the underwriting decision. It's usually better than what folks imagine.
Alright, Marcy, I'm going to ask the closing question. If listeners remember only one sentence from this entire episode, what do you want it to be?
Your premium for the life of the policy is heavily influenced by the 90 days before you apply. Not just the application day. 90 days of choices, that's the window.
Marcy Reeves, thank you for coming on. This conversation is going to help a lot of people.
Thanks for having me. I really do believe education makes the whole system work better.
Alright, listeners, here's your assignment this week. If you think you might apply for life insurance in the next 6 months, treat today as day 1. Book a physical. Get your baseline numbers. Work on what you can improve. Stop what you can stop. And talk to an independent broker before you apply so you can choose a carrier with a strategy, not guesswork. Next week is episode 5, Term Life 101, the workhorse of life insurance. We're going back to a solo teaching episode to kick off the deep dive into the actual products. We'll talk about why term is cheaper than permanent, where it fits, where it doesn't, and how to tell if it's right for you. Until then, start your 90-day plan. The clock's already running. I'm Nakel Nikiema. This is Wiseside Life and Legacy. Educate. Empower. Protect your legacy. See you next week.